So here is your assignment that you already received, right? So you know everything, you know, release, you already received it, in fact today, yesterday, but of course you received day before yesterday. So your submission deadline is the 10th of September, as we discussed before, and these are the some rules and regulations that you're supposed to know before your assignment submission. All right. So just I added one more point here, that both parts of your assignment are compulsory, right? If you see in the following pages, you have two parts, part A and part B. Part A, you have 3 questions, and part B is like as case studies, quite short case studies, right? So you have total 4 questions, part A and B, right? And you know that this is your group members name and your contribution, which is really important. Now here is your question, right? So your first question is about can our goal of maximizing the value, it's like all about shareholder maximizations, right? Goal of maximizing the shareholder value, right? Idea is that if we will avoid the goal to maximize shareholder wealth, does it indicate any kinds of unethical or illegal behavior? Right? So why goal of wealth maximization or shares value maximization is really important? If they are talking about conflict, so remember conflict, it's indicate about agency theory, right? You can also discuss agency theory in this point. So idea is that whether avoiding wealth maximizations can lead to any conflict of interest. Answer is yes, of course, because company primary objective is to maximize shareholders' wealth. That's also purpose of the financial management, right? If you are not looking at the shareholder, or you are not working in a best interest of shareholder, so which means you're working in a best of your self-interest, so which is not really good, right? So of course, it's completely unethical. It's completely illegal behavior, right? In particular, do you think issues like customers and employee safeties, environments, and general good of society fit in this framework, or as they essentially ignored? Okay, now remember, this question is talking about 2 things. One is a best interest of shareholders, right? Shareholders, the first sentence, shareholder means which are the external users, right? But besides shareholders, this question also discussing about stakeholders, right? Stakeholders like as customers, like as society, like as companies' employees. So this question idea is whether ignoring shareholder best interest and stakeholder best interest, is it create any kinds of problems? Or if we ignore it, is it good or is it bad? All right, of course, this can't be good. But of course, shareholders are more important, but it doesn't mean that we don't care about stakeholder, we just only care about shareholder. Of course not. Both are important, equally important for the companies, right? Avoiding either shareholders and stakeholders lead to be unethical behavior of the companies, right? Company need to give respect to their employees, not just only shareholder, because they are supplying money to the company. So both parties are equally important. That's all about these things. All right. So I repeat, this question break into two parts. This is part one about shareholders, and here this about part two, which is stakeholders. Right. So make sure you have to provide some specific examples in order to do this question. Right. And this question weightage is 20 marks. Right. Second questions. Your neighbors, knowing you are a study finance, ask you what is this idea of financial markets and what does it tell me, right? So what is financial market? Uh, how does it work and what it does, the role of financial markets, you have to explain to your neighbors, right? With examples. So complete information, detailed information of financial market that I explain you in the in the class, right? Next, the neighbors, your same neighbors, then say, okay, I know what is financial market, but really confused me is the ideas of financial crisis. How does it spread? Provide an example explaining in very detail what they are telling the users. All right. So financial markets and financial crisis or global financial crisis. How does it spread? Means, of course, global financial crisis. Right. 8 marks, 7 marks. Student, you remember. Make sure you remember. Keep in your mind one thing. Whatever information I provided you in the class or information comes from your lecture slides. If you're using information from your slides and textbook and then little bit information from internet, then okay, you will not lose any marks. In fact, you're gonna get high marks. But if most of information that's coming from internet, the information you are providing about financial market that I did not teach you in the class, or information about global financial crisis or financial crisis that I did not explain you in the class. If you're writing that information, definitely you're gonna get. So keep in your mind, whatever questions you are doing in your assignment, especially theory questions, not calculation, theory question one and question two is about theory questions. In these two questions, if you simply take the information from internet, even though you paraphrase that information, right? Even though you paraphrase that information, you're more likely to get low marks, right? I'm expecting you to read the slide in textbook, and I believe that you already paid attention in your class, right? That's really important, all right? So keep in your mind these things. So that's why try to use internet when you stuck somewhere. But I don't think so you're gonna stuck because all the information is given in my slides. The example I gave you in the class, I have that file. Let me show you the file. Then I will send you that file. So the file I already saved. Whatever I write down in the class, I have that file. So let me check. students. Here is the file of your complete informations that are written in the class, and make sure you save this file. And when you do your assignments, try to use this file. All right. So this is all about your question 1 and 2. So question 3 is about, suppose you are looking at the following possibles, blah, blah, blah. What is the value of cash flows in 5 year, 2 days, and 3 year? I think this kind of similar questions you already practice in the class. Just simply you have to calculate 3 different kinds of cash flows for 5 years, for 3 years, for 2 days, right? 10 marks. I believe there is no any problem. And this question is mainly about unstable dividend growth model, right? So you also know that. So you have to simply calculate the present value of company stocks using unstable dividend growth model. So 10 marks and 15 marks. Right? So that's all about your part A. Part B, again, it's also compulsory. And this is your informations, cash flows, initial investment, times and stuff, right? And then you have to calculate ARR, payback, NPV, and IRR, right? So keep in your mind when you practice when you calculate NPV and IRR, I highly recommend you to use the table method, right? For table method, right? So you have to explain me complete what is NPV and how do we calculate, how we accept, reject, everything. You have to start explaining how we reject and accept, project by using ARR, because in this question, you don't have any option with another project. You have just only one project you have to calculate. So you cannot simply make a decision, accept or reject, because you have no other project to compare, right? So that's why you have to explain me some theoretical informations first. Same thing with all these kinds of formulas. Explain a little bit, half of page or 1 page, what is ARR and what is the formulas and how we use ARR to make a decision, accept, reject. Same thing with payback, NPV and IRR, right? So NPV and IRR, you have to use a table method, right? But when you calculate the present value here and here, right, cash flows and stuff, then you have to use a formula method, right? Use the formulas to do these third questions. And this one, C and D, you will use a table method, all right? So that's all for your assignment, right? And remember your assignment weightage is 50%, and 50% will be your final exams that we will discuss next class, all right? So if we have class on this Saturday or Friday, whenever, we will discuss in the next class. For Saturday class. All right, so anybody has any questions regarding assignment? So no questions. So can we move on to the last topic, topic 8, I guess? Can we start topic 8? If no question? All right, so let's start. All right, so this is your topic 8. Topic 8, which is working with financial statement. working with financial statement. Another title of this topic is also, we call it a ratio analysis. Ratio analysis. Okay. So idea is that we're gonna understand through this topic how we're gonna use financial statement if we are planning to make any kind of decision, maybe in simple words, investment decision. All right. So first of all, we need to understand what is financial statement. Financial statement is a statement which provides company financial information. Which provides company financial informations. All right. So who needs company financial information? Who require company financial information? Idea is users. Users are the people who need company financial informations. All right. And you know that we have two types of users. One is external and another one are internal and external users. Now, the question is why? Why users, they need company financial informations? All right. They need company financial information for decision making. For decision making. That's the purpose for companies to prepare financial statement. So the main idea is company prepare financial statement for users, so users can read financial statement because it's providing financial information. So users use this financial information to make a decision. All right. Now, what kind of decision they have to make? It depends upon users to users. For example, if shareholders, what decision shareholder need to make it? Shareholder need to make about, of course, investment decisions, whether we should invest in this company or not. So by reading company financial information, shareholders, they make investment decisions. Banks, external users, what information bank they need in order to make a decision, or what kind of decision banks they need to make it. Simple. Bank lend money, whether we should lend money to this company or not. That decision banks, they have to make. So by reading financial information, they will make it decisions. Next is maybe customers, external users. Right. So what decision customer have to make it towards company? Buy product or services or not? By reading financial information, they make decision. And maybe suppliers are the people who supplies to the companies, materials to the company. And what decision suppliers need to make it? Supply material or not. All right. Same thing with the internal users, whether it's a director or employees, maybe workers, right? So different users, they have to make different kinds of decisions. Now, the question is how users use financial information to make decisions. All right. That's what we learn. Users use financial information to make decisions. All right. users use financial information to make decisions, right? But the question is how they do that. Okay, they normally analyze company financial statement through analyzing financial statement. So users, they analyze company financial statement, so they make a decisions. All right. Again, question is how to analyze. How do we analyze? In order to analyze financial statement, we have various tools. We have various tools, various methods, various approaches to analyze financial statement, so we will be able to make our right decisions. Analyze means, if you do not know analyze, evaluate. All right. In other words, we can say that make further investigations using that information. Right. So use that information in a such way so we come to the conclusion that we wanna do this, invest or not. So that's the meaning of analyze or evaluate. Right. So we have various tools to analyze financial statement, but one of the common method to analyze financial statement is called a ratio analysis. Right? Ratio analysis, one of the common method that company apply to, not company, sorry, users, they apply this approach to make decisions. All right. So I repeat, users, they use or apply this ratio analysis for decision making. Right? Users apply ratio analysis for decision making. That's the main ideas here. Is this use financial information, and how we use this ratio analysis. Of course, in order to apply this ratio analysis, what we need company financial information. So users use company financial information. You can say that. You can say that users use company financial information through ratio analysis, so they will be able to make a decisions. All right. So this is the whole idea of this topic, ratio analysis. That's why another title of this topic is a ratio analysis, or working with financial statement. So users will be able to make a decision. All right. So did you get the ideas? What is the main ideas of the today's lecture? All right. So now you got the ideas of this topic. So the idea is that in this topic, we're gonna learn about ratio analysis. All right. That the tool which is used by the different users. All right. So, okay. Now, you know that in order to understand ratio analysis, in order to apply ratio analysis, we have to understand financial statement. All right. If you do not know what inside financial statement, you may not able to understand the ratio analysis. Why? Because ratio analysis is using financial information inside the financial statement, right? So I'm going to give quick glance about financial statement, all right? So Financial statement. Financial statement. So remember, financial statement is a combination of 5 components. All right. It's a combination of 5 components, right? Which 5 components? The first one is a income statement. We also call it profit and loss accounts, right? Income statement. Second one is a balance sheet. We also call it statement of financial position, right? Balance sheet. Third one is a cash flow statement. Cash flow statement. Fourth is a statement of change in equity. Fourth is a statement of change in equity. Statement of change in equity. And the fifth one is a disclosure, or sometimes we call it notes. Notes or disclosure. Notes. Now, what is income statement? Everybody knows that income statement provide information about company profitability, which means with the help of sales and cost, we understand whether company making profit or loss. That's information we get it through the income statement, right? Now, balance sheet. Balance sheet provide information about total assets, total liability, and equity. That you also know that. Next one is the cash flow statement, which tells about cash inflow and cash outflow. Remember, only cash. That's it. No matter cash inflow by borrowing money or cash inflow by selling assets or by selling product by cash. Just only about cash items. The fourth one is a statement of change in equity. That's only represent the reason behind increase or decrease the equity. Why? In simple words, you can say that in order to understand shareholder wealth maximizations, we normally look at the statement of change in equity, whether shareholder wealth, which is equity, increasing or decreasing. If it's increasing, why it's increasing? If it's decreasing, what are the reasons behind this downfall in the shareholders' wealth, right? So this is statement of change in equity. And final notes is a disclosure. We also call it disclosure. So notes means any kinds of information that do not belongs to 1, 2, 3, 4, that belongs to notes. Any kinds of information that do not fit in income statement, balance sheet, cash flows, or equity, that comes here, notes. In other words, we can say that notes provide additional informations to users that may users need it to make a useful decision. In other words, we can say that notes also provide information about company future plannings, or if company plan to be restructured in future, right? That's also a notes. Or maybe it's provide information about if company applying a specific method, like as for example, inventory valuation method. We have LIFO or we have FIFO, right? I hope you know that. Which methods company apply to estimate the value of inventory? Is it LIFO or is it FIFO? Same thing, depreciation. If company estimating the depreciation of assets, which method is company applying? Straight line, diminishing balance, sum of digits, or double decline, something like that, right? So which methods company is applying to estimate the balance of the particular accounts is additional information that I just said, right? So for this topic, you don't have to look at all information, I mean, all kinds of components in very detail, but we require just these two. We require just these two. We call it primary financial statement. Primary financial statement. So idea is that we will use only these two components to apply ratio analysis to evaluate the financial statement. We may not need these three to apply or to estimate the ratio analysis. We also call it primary financial statement. Why primary financial statement? Because these two types of component, which is income statement and balance sheet, very commonly used by every kinds of users. We always look at these two components at first, and then we go later, maybe cash flows or statement or notes, all right? But these two, income statement and balance sheet, one of the most common components of financial statement that almost every users require, because everybody want to know company profit and loss. We always look, if we think that company is doing good or bad, first thing comes in our minds, that what is a profit and what is a loss. So we always look at the income statement first in order to understand company profitability. Same thing with the balance sheet, all right? Which means how company using its capital, all right? This is capital, right? How company invested, because buying assets called investment. So whatever money company got it, maybe through banks or bonds or shareholders, where company investing it, all right? So that's the information we get it through the balance sheet. That's every kind of user, especially shareholders, they require such kinds of informations, all right? So the conclusion is we will use only income statement and balance sheet to analyze financial statement using ratio analysis, all right? Now, you know what is income statement, you know what is balance sheet, right? But I want to give a very quick glance over income statement and balance sheet so you can really understand. If you do not know anything or you do not remember or you missed anything, then by giving you that very quick information, you will be understand what inside income statement and balance sheet, all right? So let's have a look what inside income statement. So income statement. So income statement, you know that we have sales minus cost of goods sold is called gross profit or gross loss. Let's say gross profit minus operating cost. Then we got operating profit or loss, let's say profit, minus interest, minus tax, minus dividend. And this dividend for preference shareholders, right? Then we got net income, all right, minus dividend, and let's say this dividend for common shareholders. And then we got retained earning. retained earning, right? So this is the complete structure of income statement following your financial accounting. So sometimes we call it sales, or sometimes we call it revenue, same thing. By selling product and service, the money company generated. Cost of goods sold. Cost of goods sold means manufacturing cost. And this manufacturing cost is a combination of three types of cost: material, labor, and overheads. Overhead means other manufacturing cost. We also call it other manufacturing cost. Then we have gross profit minus operating cost. Operating cost means non-manufacturing cost, right? Non-manufacturing cost. Non-manufacturing cost may be like as administration cost. Administration cost means any kinds of cost related to office, maybe office supplies, I guess electricity and water, and the office staff, the people are working in office, maybe human resource department, maybe account department, maybe marketing department, and so on. And we have a marketing and advertising. Companies spend money on marketing and advertising. That's called non-manufacturing cost. And another example of operating cost or non-manufacturing cost is distribution or transportations, right? Distribution. We have to distribute our products to the seller, or to the reseller stores, or directly to the customers. Then we have to spend money for transportations or distribution. That also belongs to non-manufacturing, right? Then we got operating profit. Okay. Once we have operating profit, then you know that we minus interest first, tax, and dividend. That you know that because we already study in a stock valuation topic. Then you know that preference dividend we pay after paying interest and tax. And then we got net income. And then we're gonna pay dividend. And after paying dividend to common shareholders, whatever money is left, that's called retained earning. All right? Okay. So one thing you please note down that another name of operating profit, we also call it net profit before. Net profit before means before interest, tax, and preference dividend. This number called net profit, and net profit before, right? So here we also call it net profit after. After means after interest, after tax, and after preference dividend. Because sometimes in your questions or in the formula that we use it for ratio analysis, they simply use net profit or net profit before. If they're writing net profit before, you may not know what does it mean net profit before. So net profit before means operating profit, and net profit after means net income. All right. So this is the ideas for your income statement. Is it clear? Any questions regarding income statement? So let's move on to balance sheet. Right. Balance sheet. Balance sheet. And you know that, as I said, balance sheet is a combination of total assets. We have total assets equals to total liability plus equity. All right. That is balance sheet. Okay. Now, what inside total assets? In total assets, we have current assets and non-current assets. And you know, current assets that we study in our previous topic, which was working capital management. So we have cash, right? We have account receivable, right? And we have closing inventory, right? So this is your current assets. And non-current assets include land and building, right? Plant and machinery, right? Maybe equipments, some kinds of equipments, maybe some kinds of tools, maybe furniture, right? Maybe vehicles. Vehicles, right? So these are the non-current assets. So make sure you know these kinds of items. What inside current assets and what inside non-current assets. Land, building, where is that? Is it balance sheet or is it income statement? Of course, it's a balance sheet because it's the assets. So you need to remember all these kind of things. Now we move on to the liability sides. Total liability, same, we have two types here. We have current liability and non-current liability. Current liability, you also know that we have accounts payable, right? Non-current liability, and maybe bank overdraft, that's also a current liability, or any other kinds of any other kinds of short-term liability which is due that we haven't paid it yet, right? Which is due. Maybe it could be a tax payments, maybe a dividend, maybe a salary, or any other things that due that we haven't paid it yet. So that's called outstanding sometime. So that's called a current liability. Next is a non-current liability. That's, you know, that non-current liability involve long-term bank loan. So current liability could be a short-term bank loan, but I'm not writing here. You know that. Non-current liability is a long-term bank loan, right? So bank loan, right? And could be bonds, you know, that municipal bonds or corporate bonds, whatever. So that's also a non-current liability or a long-term liability. All right. So these are the assets and liability. Now move on to the, maybe we have some more items, but I'm going to give you very standardized information, so not too much or not too less. All right. So that's enough information for you that you can easily find in every kinds of financial statement, right? Next is equity. So equity involve, of course, we have common shares, right? We have preference shares, right? Common share, preference shares, and we also have retained earning. All right, retained earning means this one. It's belongs to your equity. Why it belongs to equity? Same thing that I explained you before when we study about stock things. Remember, if company pay high dividend to shareholders, retained earning will be reduced. All right. If company paying low dividend, company high profit, company making high profit, but company paying low dividend. Why? Because company looking for new investment where company require more and more money. So company will use this retained earning for reinvestment purpose. All right. If company will not reinvest it, technically that money belongs to the equity. All right. Technically, it belongs to the common shareholders. Right? So sometimes another word for equity is a residual interest. Residual interest means equity. Write down here. Residual interest. Residual interest means equity. It means equity. Whatever is left, that's called residual interest. After paying everything, that's what we are doing here. After paying everything, whatever is left, or total assets minus total liability, whatever is left, called equity. That's why another name of equity is a residual interest. All right. So this is the informations about income statement and the balance sheet. You must know. All right. So before we move on to now ratio analysis, anybody has any question? Anything is unclear or you did not understand? Any questions or move on? OD stands for overdraft. All right. OD stands for overdraft. So let's move on. Okay. Now ratio analysis. Ratio analysis. Now, what does it mean, ratio? What is the use of ratio? So remember, ratio basically help us to compare two informations or two datas or two values or two numbers. All right. Comparison between two datas called ratio or ratio analysis. So we are using two informations, two values, two different datas or maybe financial informations. All right. We're going to use these two values, two datas or two informations to make a decision. All right, that's called the ratios. Here, we're going to do exactly same thing. We are picking two different informations. Maybe these two informations comes from, maybe these two information come from income statement, all right? Or two informations come from balance sheet, or one from income statement and one from balance sheet, all right? So we are using these two information, and by using these two informations, by calculating something using these two information, whatever outcomes or whatever number we have, that number will help us to make a decisions. All right, decisions about invest or not to invest, as I said, not just about shareholders investment decision, any kinds of decisions. All right, so this is the ideas for ratio. Now ratio analysis, we have a 4 kinds of ratios under this ratio analysis, right? The first one is a profitability ratio. Profitability ratio. Second one is a efficiency ratio. Third one is a solvency ratio. And the fourth one is a shareholders investment ratio. So we have 4 different kinds of ratios. Let's talk about profitability ratio. Now, with the help of profitability ratios, users can understand firm ability to make profit. Firms ability to make profit. Whether this firm gonna be a profitable in near future or not. All right, or using the past information that coming through the financial statement, what was the profitability of that firms, how much profit company that generated by comparing something. All right, next is a efficiency ratio. Efficiency ratio basically tells us assets utilization. Assets utilization. In simple words, that whether company using its assets efficiently or not. In simple words, whether company using its assets in a right way or not. Let's say company bought assets, company invested money in the assets, but company is not frequently using these assets. All right, so which means if company is not using that assets frequently to maximize its production or sales or any other return, so that means that investment is not really useful. So that's the ideas for this efficiency ratios. Next is a solvency ratio. Solvency ratio explain about ability of firms to pay debt. Ability of firm to pay debts, maybe in short run or long run. In simple language, company has enough ability to pay its bill or not. And the company can pay its bill or not. That's called a solvency ratio. And the last one is a shareholder investment ratio. Shareholders investment ratio help us to understand that or this kind of ratios provide informations to shareholder so they will be able to make a right decision, right? Or by looking at shareholder investment ratio, shareholders will be able to make a decisions. This is called shareholders investment ratio. So we have these 4 types of ratios. All right. In these 4 types of ratio, we're gonna study some more ratio inside each ratios. Like for example, in profitability ratio, we have 4 ratios in profitability. In efficiency, we also have 4 ratios. In solvency, we have 5 ratios. 2 ratio for short-term solvency and 3 ratios for long-term solvency. And shareholder investment ratio, we have 3, right? So total we have 16 ratios, 16 formulas. By using these different formulas, we will be able to understand the different information. Right? I think I haven't sent you the lecture slides for this topic, so let me send you slide first, and then we continue with the profitability ratio. So make sure you use this file, or you download this file. This is for topic, this topic 8. So let's move on to profitability ratio. Right. So profitability ratio. So under profitability ratio, we have first ratio, that is a gross profit ratio. Gross profit ratio. Gross profit ratio tells us about product profitability. Product profitability, which means this product, is it profitable to produce or not? If it's profitable to produce, that's we will continue with the production. If it's not, we stop it, or we find the way to minimize its cost so that product could be a profitable for us, right? So this is called a gross profit ratio. So formula for gross profit ratio is a gross profit divided by, if it's gross loss, then of course we don't have to calculate. So gross profit divided by sales multiply by 100. So your answer will come in percentage, right? Percent. So one thing I forgot to inform you in the beginning when I was explaining about ratio analysis, that in ratio analysis, in order to make a decision, you're gonna calculate ratio for 2 years, all right? Not only for 1 year. For example, gross profit ratio. we will calculate this. We will calculate this gross profit ratio for 2 years, last year or last year and this year, or maybe last year, last to last year and last year and last year and this year. All right. So remember, every time we have to calculate gross profit ratio for 2 years, all right, last year and this year. By comparing last year number and this year number, we will make a decision, all right, good or bad. So for example, compared to last year, if this ratio increase, good. If is this ratio decrease, which is bad. I repeat, this percent that we calculate last year gross profit, last year sales, so we got last year gross profit ratio, and this year gross profit, this year sales, we got this year gross profit ratio. So we got two gross profit ratio. Compared to last year, if this year gross profit increase is good, all right, good for company. If this is compared to last year, if this year gross profit decrease, bad for company. All right, so by we make decision by increase, good, decrease, bad. So this is your gross profit ratio. Next, which is B, net profit ratio. Net profit ratio, of course, it tells us about overall profitability of company. Overall profitability of company. So formula is net income divided by sales multiply by 100. Again, your ratio will come in percentage. Right? If this ratio increase, good, decrease, bad. Right? So this is your net profit ratio. Next, C. This is your return on capital employed. Return on capital employed. So this ratio tells us about the usage of company. So whatever capital company employed it, what is the return on it? All right, how much profit or how much return company is generating by using its capital. All right, so usage of capital, as we can say that. Usage of capital. So company using its capital in the right way or in the wrong way, right? So the formula is a operating profit divided by equity plus debts, total debts, you can say that. So equity plus debts will be equals to a capital, right? Equals to capital. And you can multiply by 100 and that will come to your return, right? If increase compared to last year, good, decrease, bad. All right, so this is the way that company use its or users use its ratio analysis over the company capital employment. All right, and the last, which is D, last ratio is a return on equity. Return on equity. Okay. Now, return on equity is similar to capital employed, return on capital employed, but the difference is that in capital employed, we finding the return of total capital, right? But here we are only estimating the return on shareholder investment. Whatever money shareholder invested, how much we return we are making on it, and which is really, really important in order to indicate, so in order to show to shareholders that we are using shareholders' money, which is equity, in the right way, right? So formula is, so return on capital means return on capital. Yes, that's indicate the shareholders' money, usage of shareholders' money. You can say that. Usage of shareholders' money. Shareholders' money. So the formula is a net income divided by only equity. Only equity multiplied by 100. Ratio, answer will come in percentage. Again, increase, good, right? Decrease, bad. Right? So remember, there is a difference between the formulas for return on capital employed and return on equity. In return on capital employed, numerator is a operating profit, which is net profit before, and denominator is capital, equity plus debts. But in return on capital employed, numerator is a net income. Why? Because equity means common shareholders' money, and which is after paying everything, and net income means after interest, tax, and preference dividend. That's why in numerator here, net income, and return on capital employed, numerator is a operating profit. And under return on equity, denominator is equity. Why? Because we are comparing the return with the equity. So which means we are finding whether shareholders' money, how much return we are generating using shareholders' money. All right, so this is your return on equity. That's all about your profitability ratio. Any question regarding profitability ratio? Any questions? Anything is unclear? If no, then move on. So now next ratio is a efficiency ratio. Which is utilization of assets. So the first ratio for efficiency ratio is a assets turnover ratio. Turnover ratio. What this ratio tells us? This ratio tells us the turnover of the assets, which means how much, what is a turnover? Means again, Are we using our total assets good or not good? One thing I want to give you ideas. So remember, if your question says return, so which means we are talking about profit, right? If your question says turnover, turnover means sales. Right? Turnover represents sales and return represents profit. So remember, I hope you know that, but in case you don't know. So if this question is, this is about turnover ratio, which means we are talking about sales, right? So using assets, that's the purpose of this, using assets. So the formula is sales divided by total assets. All right, sales divided by total assets and multiply by 100. You will be in percentage turnover. Right. If this ratio increase, good, decrease, bad. All right, so means the usage of particular assets or the total assets. So in denominator, we are writing the value of the total asset that you can easily find in your balance sheet. All right. Next ratio is the inventory turnover period. Inventory turnover period. So let me check one more time. So inventory turnover is, this ratio basically tells us how long we are taking to finish our inventory, how frequent, how fast our inventory is running out from the store department, all right? So in other words, we can say that again, the usage of inventory, all right? How fast we are using our inventory or how fast inventory is running out from the store department, all right? So again, usage or using inventory, how fast. Formula is a inventory, closing inventory. Of course, you have to go to the balance sheet, total assets, current assets. And under current assets, you have a closing inventory. So inventory or closing inventory. Inventory divided by cost of goods sold. The inventory already used it, and the inventory already left. And multiply by 365. 365 indicates your days in a year, right? So if you divide inventory by cost of goods sold and you multiply by 365, you get number. So which means that number will call days, whatever number you get it, all right? Days. So now, if these days higher compared to last year, not good. If lower, which is good. What does it mean? Compared to last year, so let's say last year my inventory turnover period was 60 days, right? And this year my inventory turnover is maybe 80 days, right? So compared to last year, my inventory turnover period is increased. So which means compared to last year, we are taking 20 days extra to finish the inventory. So which means that's kind of outflow of inventories, or kind of like slow or downfall in the outflow of inventory indicates that company production has been reduced. That's why the usage of inventory also decreased. We're taking more time, 20 days extra, because production has been reduced. So why production decrease? Because sales decrease. Why sales decrease? Because customer demand decrease. All right. And what are the reasons demand decrease? Maybe economy slowdown, or maybe product out of fashions, or any other reasons, quality or any other reasons. But the idea is that if this ratio means inventory turnover period increase, bad, decrease, good, right? So this is the ideas for inventory turnover period. Next, this ratio, you know that, but I haven't told you that how to calculate. This ratio is accounts receivable collection period, right? Accounts receivable collection period, right? Now, what this account receivable collection period? Same ideas, how fast or how long account receivable take to return money back to us, right? How long account receivable takes to return, all right? How fast or how long account receivables are taking to return money back to us, all right? Now, the formula is, you know these ratios, collection period, but you do not know how to calculate. So I'm going to explain you how to calculate. So formula is account receivable divided by sales, normally credit sales, but if there's no any credit sales given in the questions, if you have just a specific information, then you just simply use the sales. Normally we use account credit sales. So account receivable divided by credit sales or sales, multiply by 365. Again, your answer will come in a day, or days, in days, right? So if this ratio increase compared to last year or decrease compared to last year, if this ratio increase, good or bad? Tell me. If this ratio increase compared to last year, good or bad? Bad. That's right. It's bad. Increase, bad. Decrease, good. Right? Why bad? Because it says that if it's increased, so which means compared to last year, we're taking a more time to receive money from account receivable, and which is not good. Why? Because as we explained in the working capital management system, that if account receivable taking more time to return money back to us, that also giving a sign of bankruptcies or signs of bad debts. All right. So if they are bad debts, if you have a significant amount of credit sales, then your profitability negatively affected. All right. So that's why make sure they are return money back to us on time. They're not taking much time to pay us money back. So this is the account receivable collection period. Next is the last ratio is accounts payable payments period. That you also know that we also covered in the previous session. Accounts payable payments period. Right, so here, how long we take to return money. How long we take to return our accounts payable. How long we are how long we are taking to return money back to our accounts payable, because we purchased on credit, right? So the formula is accounts payable divided by credit purchase of raw material. But sometime in the questions, we do not have information about credit purchase. So instead of using credit purchase, we can use the cost of goods sold. It will not give us the exact ratios, but yes, we can get some kind of estimation, because in this cost of goods sold, we have material, but of course we have labor and overheads. But anyway, we don't have any other options if we don't have a credit purchase. So just use cost of goods sold. But find the questions give you credit purchase or not. If it's not, then you can use it. And multiply by 365. Again, your answer will come in a days. So increase, bad, decrease, good. Why increase bad? Because if you are taking longer period to pay money back to our accounts payable, what does it mean? It means our cash flows has a problem. We may not have a sufficient cash flows to return money back to accounts payable on time. So longer means you cross the due date. All right, if it's high means cross the due date. So let's say due date is 60 days and you're taking 70 days. So taking a longer period. So you're taking 10 days extra. Why taking 10 days extra? Because you may not have enough cash inflows in your company. So you have to wait to get some cash inflow. So you will be able to make a payments for accounts payable. If it's shorter means you making a payments on time or before time, that's fine. Why? Because same thing, if you're keeping an excess cash, so you will not have any problem to pay money accounts payable on time, because you're having excess cash. So you can use it to make payments, right? On time or before time. That's not bad at all. All right, so that's the ideas for accounts payable payments period. So accounts payable payments period is finished. Any question, efficiency ratios, or we move on? Okay, so move on. So next is a third ratio, which is solvency ratio. Solvency ratio. As I explained you before, that in these solvency ratios, we have two types of ratios, short-term solvency and a long-term solvency. So let's start with the short-term solvency. Short-term solvency. Short-term solvency means ability to pay debts in a short period of time. So which means ability to pay short-term debts. That's called short-term solvency ratios. Right. So ability to pay short-term debts. All right. Ability to pay short-term debts. Now, in this solvency ratio, the first ratio is a current ratio. So it's quite similar to the working capital management system, right? So what is current ratio? Under this current ratio, we are comparing cash, we are comparing current assets with current liability. Why? Because uh, current assets signify the cash inflows, and current liability indicates the economic outflows, right? So comparing inflow and outflows. So that's what we are exactly doing in current ratio, right? So the formula for current ratios is a current assets divided by current liability, all right? And your answer will come in a ratio. Or what does it mean? For example, current assets may be 1,000 and current liability is, let's say, I don't know, 500, right? So current assets divided by current liability, so it will be 2:1, right? So which means we have two current assets for one current liability. Right? So your answer will come in a ratio. So you have to write answer like this, right? Okay. So now increase good, decrease bad, but increase but increase too much is bad. Decrease too much also bad. All right. Normally increase good, decrease bad, but increase too much bad, decrease too much very bad. So do we have any kinds of standard ratio? Yes, we have. So standard ratio is 2:1. All right. So which means your current assets must approximately double of your current liability. It should be double, right? So 2:1. If it's close to 2:1, that's right. Compared to last year. So let's say last year was 2:1. And this year 1.9:1, which is not good because compared to last year, it reduced. All right. But let's say last year 5:1. And this year 7:1. This is not good. Why? Because you are holding too much current assets compared to current liability, and which is not good. That what exactly we learned from the working capital management system. Under working capital management system, we cover cash management system, and in cash management system we learned that instead of holding cash, we should invest cash. Just hold enough, do not hold too much, because holding do not give you return. Investing money will give you return. All right. So by that reason, holding too much current assets may not a good sign. All right. So that's why we have a standard ratio, which is 2:1. All right. Next. So let's continue with the current ratio. All right. So this is a 3 solvency ratio. Solvency ratio. Under solvency ratio, we talk about short-term solvency ratio, which is a current ratio. So current ratio which is current assets divided by current liabilities. So standard ratio is a 2:1, right? Okay, so let's talk about next, which is I would say that improved version of quick ratio. So this is A and B. So next is a quick ratio. Quick ratio. Quick ratio is better than current ratio. Why? Because if you have a look, current assets divided by current liability. But if you have a look, this current assets, in this current assets, we have cash, we have account receivable, and we have inventory, right? For example, my current ratio is 2:1. So which means 2, let's say it's not 2, so let's say 3. 3:1. So 3 my current ratio, current assets, and 1 is current liability, which is good. But the problem is, for example, in these 3, so current ratio is 3, current assets. So in these 3, let's say cash is 0.5, all right? Account receivable is 1.5, and inventory is 1. So which means I have only 0.5 cash available in order to make a payments for current liability. Why? Because we normally use cash to make up payments for current liability, not account receivable, not inventory, all right? So that's why that current ratio may not provide the exact picture of the company's, I would say that company financial strength, right? So in order to understand that kind of cash strength of the companies, we will have another ratio that's called quick ratio, right? Or liquidity ratio. So the formula for quick ratio is a quick assets divided by current liability, right? So under this quick assets means current assets. So quick assets means current assets minus inventory, all right? Inventory. Current assets minus inventory called quick assets. There's a quick asset divided by quick liability, current liability. So we have also standard quick ratios, which is 1:1. So shouldn't keep too much cash or equivalent to cash in order to make a payments for current liability. Why? Same reason, same ideas. Investing cash is better than holding cash. So that's all about your solvency ratios. Let's continue with a long-term solvency, which is B. Long-term solvency. So ability to pay in a long-term debts. All right, ability to pay long-term debts ability. So the first long-term solvency is a gearing ratio. Gearing ratio. Formula for gearing ratio. A student, now gearing ratio. So gearing ratio basically help us to understand that in our total capital, how many debts we have, all right? So always remember, total capital is always 100. If debts are 40, equity is 60. If debts are 60, equity will be 40. So with the help of gearing ratio, we can understand the weightage of debts in capital, all right? Weight of debts in total capital, right? The weight of debts in total capital. The formula is, remember, only long-term debts. Long-term debts divided by equity plus debts, multiply by 100. Your answer will come in a percentage, right? If it's increase, bad; decrease, good. Why increase bad? Why? Because the total debts are increasing, which means borrowing increasing, obligation increasing, liability increasing, periodic payments also increased. So that's why company obligations may increase in a longer period of time. So this is a gearing ratio. Second one is the equity to assets ratio. This ratio exactly opposite of gearing ratio. In this ratio, weight or weightage of equity in total capital. All right, here are debts and here is equity. Formula exactly opposite: equity divided by equity plus debts, multiply by 100. Your answer will come in percentage. Increase, good; decrease, bad. Why increase, good? Because if equity increase, debts decrease. If debts decrease, company fixed periodic payments may be increased in a longer period of time. That is equity to asset ratio. And the third one is a interest coverage ratio. Interest coverage ratio. Interest coverage ratio basically tells us whether we are making enough profit or not, or profit or not, to cover the interest, because interest is a fixed periodic payments, right? Interest known as fixed periodic payments. So we are making enough profit to cover our fixed periodic payment, which is interest or not. So formula is a operating profit divided by um, interest, and your answer will comes in times. All right, one time, whatever number, one time, two times, three times, four times, how many times profit we are making compared to the interest. All right, so if this ratio increase, good; decrease, bad. Why increase, good? Which means we have more profit to cover the interest, so we don't have to worry. All right, so this is the ideas for solvency ratios. Solvency ratio is finished. Any question before we move on? So let's move on if no question. Now we move on to the last ratio. So last ratio is a shareholders investment ratio. Shareholder investment ratio. In this shareholder investment ratio, the first ratio is a earning per share. Earning per share. So call it EPS. All right, earning per share. Now, what this ratio tells us? This ratio tells us that how much money we are earning on one share. All right, how much money we are earning on one share. That's called earning per share. Formula is a net income divided by number of common shares. Remember, number of common share, not the value of common shares. And then if you solve it, your answer, whatever number will come, it will be dollar per share. That will be your answer. So which means that dollar you are earning on one share. So net income divided by number of shares. If this increase, good, decrease, bad. All right. So earning per share, EPS. Next, number 2, which is price earning ratio. Price earning, PE. Price earning ratio. In this ratio, we are comparing market price with the earning per share. Market price per share and earning per share, which means we are comparing how much is the difference if we sell at market price or we hold the share. Because if you sell it, whatever price is available in market, you get that price. Or if you hold it, you will have earning per share. So we are comparing it. So the formula is a market price per share, divided by earning per share. Market price per share, earning per share. All right, and your answer will comes in times, right? Yes, your answer will comes in times. So increase, good, decrease, bad. Increase good means the market value of the share is increasing over the period. All right, the market price is increasing. All right, so a very general rule to understand, to make a decision good or bad by looking at the market price. So let's move on to third one, which is dividend cover ratio. Dividend cover ratio. All right. So formula is so what does it mean, dividend cover ratio? Dividend cover ratio basically tells us that are we making enough earnings to cover dividend or not, right? So always remember the profit we earn, all right, or the dividend we earn and the dividend we receive, it's maybe different. Why different? So let me write down here. So let's say this is operating profit, all right, minus interest, minus tax, minus preference dividend. Then we got net income. Then we pay minus common share dividend. Now, what does it mean, net income? Net income means money you earn. So that's why earn divided by number of shares. So that's called EPS. And dividend means the dividend actually company pay. Dividend company paid and divided by number of shares. So this is called DPS, dividend per share. So earning per share means the profit we earn it, and the dividend company pay called dividend per share. We can calculate dividend per share by the total money company paying as a dividend, let's say $10,000, and divided by number of share, let's say number of shares are 20,000. So 50 cents one share, you receive a dividend. And the difference between, so the difference between EPS and DPS, it's called retained earning. All right. The difference between EPS and DPS called retained earning. Why? Because if the DPS here, this is DPS. If DPS increase, retained earning, so here is retained earning, right? If DPS increase, retained earning decrease. If DPS decrease, retained earning increase, right? So this minus this is this. All right. So dividend coverage means, are we making enough profit to cover dividend or not? So that's the ideas for dividend coverage ratio. So so the formula is as I said, EPS divided by DPS, and your answer will comes in a times. Increase good, decrease bad. Increase good, why? Because we are generating enough profit, so company don't have to worry about paying dividend, right? If company making a low profit, then may company have to pay dividend to attract its shareholders. Same thing, same idea that we studied before. All right. If company making enough profit, the company may give less dividend because company want to maximize its retained earning to reinvest it. All right. But if company generating low profit, then company has to meet the keep the shareholders in the organizations, or give them reliance, or keep attracting them by paying a high dividend. All right. It's all about the dividend policies that company implements, or company may change over the period. So that's the dividend coverage ratio. Dividend coverage ratio is finished. Shareholders investment ratio, finished. So old ratios, finished. Now you receive the file I sent you before. In that file, we have assets, liability equity, which means we have a balance sheet and we have an income statement for 2 different years. So using that balance sheet and income statement, we're gonna calculate all kinds of ratio. But again, you have to remember where is that particular information. All right, like for example, if you are calculating earning per share, you have to find where is net income, where you can find net income. Of course, net income, you have to go to the income statement. Number of common share is about common share. Common share belongs to equity, and equity is the balance sheet. Same thing, market price also given in your question. Earning per share, it comes from here. DPS maybe come from your income statement. EPS, you already calculated, right? Same thing, you have to do like current ratio, current assets, balance sheet, current liability, balance sheet. All right, quick ratios, current assets minus inventory. Of course, inventory is in the balance sheet, closing inventory, current assets. All right. Same thing with the gearing ratio, long-term debts, where you can find long-term debts. Again, it's a liability, equity plus debts, balance sheet. Again here, operating profit, income statement, interest, also income statement. Right? Same thing with the efficiency ratio, no matter it's an assets turnover ratio, inventory, account receivable collection, accounts payable payments period. So you have to remember all the formula first of all, because again, your final exams that we will discuss on this Saturday will be closed book. So you need to understand all the kind of formula, and of course you have to remember all the formulas. And second thing is you have to understand this formula, this information, where I can find this information in my financial statement. You go to either, so remember, all the information, either income statement or balance sheet. No cash flows, no statement of change in equity, and no notes. All information you can find only in primary financial statement. All right? So understand? Yes or no? Is it clear? Everything is clear? Okay, so any questions before we stop? So remember, in the next class, we will discuss. We will do the question first. The file I sent you before, PDF file. We calculate all the ratios, right? First thing we're gonna do, and second thing, we will discuss about final exams, right? How many questions, type of questions, closed book, open book, multiple choice or long answers, and so on. Everything we will discuss in our next class. All right, and as I said, next class, which is Saturday, gonna be a last class. So if anything is unclear to you regarding your assignment, you can ask me question. All right, so if no questions, so can we stop here? Okay, so we stop here. I'll see you on Saturday afternoon, 1 p.m. Thank you. See you.